Good morning, option strat traders. Steve Ganz coming to you for the last time from my Kauai trading desk. I got another beautiful sunrise here, and I will be heading back to Southern California on Monday. So future posts will be from California. And anyhow, a couple quick things here. First of all, I want to thank everyone for their feedback on the compare and contrast series. I think that looks like it's going to be a hit. So my game plan is going to be that every week, the first output that I do during the week, the first video will be one of the compare and contrast series where we're going to compare and contrast different types of options trades and why you might choose one over the other to analyze and, again, open paper trades in and see how they work. The goal of this is to give you two potentially similar options trades that a person might consider, and then have you open them both in paper and then study and analyze how they react in different market conditions. So I think that'll be a really valuable lesson going forward. So the second post that I plan to do in most weeks is going to be a trade concept or an idea. Again, a paper trade concept or idea. So I want to look today, I'm looking here at our flow and kind of a summary of our options flow. Now there's one thing that stands out to me here that might not stand out to most people. So I'm predominantly an SPX trader, which is what we call one of the large indexes. If you're familiar with the ETF of SPY, SPX is like 10 times the size of SPY. So it's 10 times larger than SPY. It has some other benefits depending on where you're located in the world. It can have some tax benefits for trading purposes, things like that for people based in the US. Now, I'm not going to try to be a tax advisor here, but you know, if you are a trader and your size permits it, you may want to talk to your tax advisor and look into SPX and what the tax advantages might be there for you, if any. But what I want to look at right now is specifically, this stands out to me. Well, why does this stand out? Well, one, this is a large index, largely traded by professionals. That's probably the first thing. The second thing is, look at the volume here, 121 million, and this is bullish flow. So let's look a little deeper here. Now, if you are in the free version of Option Strat, you probably don't have this. So this is something that is in the premium version, but let me show you why it's so valuable. So I can come in here, I can look at this flow, and this flow is telling me that, you know, people are buying long calls, and they're buying a lot of them, 9 million, 4 million, 970,000, etc. So a lot of money is going out here in bullish positions. And this is being put out by people that are largely professional traders. Again, that's the people that trade SPX. Many times it'll be people like myself that are trading professionally, but even much bigger than me is going to be hedge funds and people along those lines. So there's a lot of people that have a bullish sentiment about our market right now. And what makes this even more bullish is in some cases they are paying above the ask price to get into these positions. So that's telling me not only are they bullish, but they're bullish in a way that they're going to pay up in some cases above the normal mid price to get into that position. So let's take a look at a chart. So why might a chart also lead us toward this same general conclusion? Well, our SPX, these are daily bars here, so each bar represents 1 day in time. So, you know, this covers a significant amount of time, a full year here. We've been in a wedge pattern. Now, a wedge pattern is where we're making lower highs and higher lows. Now, there's no guarantee as to which way a wedge is going to break. However, when there is a break from a wedge pattern, it generally is a pretty significant break. It happens fairly quickly, and once that break occurs, a lot of people will pile in the direction of that break. Now, what's leading us a little bit to an upside break is if you go and study technical analysis and you look specifically at wedge patterns more often tend to break to the upside. Doesn't mean they're always going to break to the upside, but they tend to break more to the upside. We can also see that this is consolidating toward the upper side of this wedge. That's also a bit of a bullish sign. So there's a lot of things here leading toward a bullish sentiment in our overall markets. So what might we want to do about that if we have a similar opinion going out here maybe a month, 2 months, whatever? Many of these options are out a little ways in time. So if we have a bullish opinion of our market, well, let's come in and look at our build plan, or excuse me, actually our optimize here. And we can say that we have a bullish sentiment. Maybe even we have a very bullish sentiment, okay? So if we have a bullish or a very bullish sentiment, we might want to consider something like just a straight long call, okay? So that's a decent trade when we are in a little bit lower volatility environment like we're in right now, and we have a very strong bullish sentiment. That's what most of these people seem to be doing looking at the flow. But maybe we want to be a little more, I don't know, circumspect than that, or maybe we're not real sure. In those cases, we can do things. We still have the long call, but we can also do things like a bull call spread would be a good one, or a bull put spread. This is actually going to be something that I want to do in our compare and contrast series, is compare these two, because one of them we are selling options, one of them we are buying options. It gives you a very similar trade profile. So what are the pros and cons of doing those two different trades? That's actually something that, again, I want to look at in this series going forward. So for right now, I'm going to look at the bull call spread. And I'm going to look at this in SPX. So this will be a little bit of a larger trade, if you will. When I say larger, I mean a little bit larger in risk and reward. But you could also do this same trade with less risk and reward by trading SPY. The reason I'm going to show this in SPX is because that's what a lot of the big boys are buying right now. And again, this is a paper trade, so it's a good trade to learn from. So what we can do here, this is our market right now. If we think we might go up from here, well, this trade is probably really good just the way it is right now. Now, I am going to go here to June 16th. I'm going to go to the AM expirations. Now, this is another thing about SPX. And SPX trading is largely what I teach. But the AM expirations, again, it's a little confusing here. These are what we call monthlies. They tend to be a little more liquid many times than the weekly expirations or the Monday, Wednesday, Friday expirations. So that's why I'm going to go to them. I'm going to go to this June 16th AM expiration. And if we're currently trading somewhere around here, around our 41.22 or so, I might want to shift this a little bit. And these little bars here also, by the way, will show me the volume at these various locations. I like to trade where there's a lot of volume because that gives me liquidity when I'm looking to get in or out of a trade. I can also size this in a lot of different ways. So here, this is going to be a little bit what we call in the money. So this basically means that if it decays in this particular location or higher, things are all good for me. So right now, if the market would be able to come back here to around this 41.20 or so range before, now this is all at expiration, before my trade were to go negative against me. Now, of course, this shows my time in trade, or what we call our T0 line. So as of today, if I enter this trade, this is where it's going to be at. If we get a sell-off right away in this thing, I'm going to be down a little money, and I could be down a little money fairly quickly if that trade, or if that sell-off happened rapidly. However, as time progresses, this is going to start to work its way back higher to where anywhere up in here is going to be decent profitability for me. So one of the things that we've done in the past is we've layered into trades. Let's just say we get into this trade, we get our breakout, and the market gets up here to 41.50, 41.60, something along those lines. That's when you may want to consider modeling in a call spread. Okay, we would sell a call spread at that point, turning this into an iron condor. That's a little further down the road for right now. But what I'm going to look at right now is just this simple trade. So what is our winning scenario? What is our losing scenario? Well, if this thing pulls back much, at expiration, I would be down significantly in this trade. Okay, but I have a bullish thesis at this point, and I can define how bullish of a thesis I want. In other words, how much room do I want to give this to the downside? So this is one of the awesome things that I can sit here and do with OptionStrat, is I can simply just play around with this. I can move these strikes to a bunch of different locations and kind of decide where I want to place my risk, where I want to place my reward. So at the end of the day, again, these people that we were looking at in flow all seem to be pretty darn bullish. Our chart here is showing pretty darn bullish. If we did get a pullback here, it might be into the 40-50 range. So we need to look and see, well, what's that going to do to us here in a week or two, if that happens fairly soon. So let's just say we get a pullback to 40-50. You know, we're going to be looking at being down $400 or so in this trade. Are we okay with that? So again, if you're talking about SPY, it's going to be 1/10 of that. You'd be down about $42 or so in this trade. So I am okay with that. I am willing to accept that risk as part of my trade. So I'm going to go ahead and save this trade. And again, always paper trade. And that's it. I'm going to go ahead. I'm going to copy this link. I'm going to share this out to everyone. And that's a walkthrough of a bullish-based trade that is based off what I've seen professionals largely trading in options flow. So that should do it. This should be the last post here from Kauai. I'll see you all when I'm back in California, and we'll dig deeper on the compare and contrast series. Thank you, everyone.